So what things should enter your mind when you're entering an employee share scheme? Income tax, not necessarily income tax of the company, but income tax of your employees. And that's something that I'm going to try to impart onto you, because very often we see employers thinking, I want to give something to my employees. I want to give them a whole lot of value. I want them to take part in the company. One thing you have to put yourself into is the shoes of the employee. Does the employee actually value what you're giving them? And very often, the income tax will come into consideration. If you give them some shares which are worth $5,000, but they have to pay $2,000 of tax on that, straight away you've got some loss in value. So you have to think about not just what you're giving, but what the employee is receiving. So income tax is going to be a big part of that, and capital gains tax, obviously, on the employee would be part of that. Fringe benefit tax, as long as you structure your employee share scheme properly, that doesn't come into consideration. But that could come into consideration if you decide to move slightly away from a traditional employee share scheme, and instead you decide to go with a remuneration type of scheme which falls closer to the provision of non-monetary value. Pay-as-you-go withholding. So again, pay-as-you-go withholding generally applies to bonuses, salary type of remuneration, would not apply to an employer share scheme as long as you structure it properly. Payroll tax. Payroll tax is very often the hidden cost for the employer, because you structure your employee share scheme, you go through all the hoops, and then a few years down the track, once the vesting conditions kick in and your employees finally have access to the shares, well, you get the tax bill as an employer. So that's something to consider as part, when you plan your employee share scheme and what the cost is going to be to you as an employer, you need to keep those considerations into mind. And tax concessions. Now, tax concessions is generally the reason why people start considering employee share schemes, because they hear about it in the news that the government has relaxed the laws and suddenly there's some tax concessions for everybody. So that's generally the reason why people are interested in employee share schemes, and that's definitely a valid reason to get into them. So we'll consider these issues throughout this session. Now, as I said, a very important part to consider is what are the tax implications on the employees. So to illustrate that, we're going to consider employee share scheme options. So the concept behind employee share scheme options is what you give to your employee is an option. You give them an option that if they satisfy the vesting conditions, they will then have the opportunity to convert into shares for an exercise price, which could be nil. So there are 4 different categories of employee share scheme options that would qualify as genuine employee share schemes and would fall within the definition of what we've been analyzing today. Those 4 categories are upfront tax treatment, which is the default tax treatment, upfront tax treatment with a reduction, a concession pretty much for employees, tax deferral, and the startup concessions, which are fairly recent, have only been around for a couple of years. So we choose to look at all of these through a timeline, because that's generally the main difference between those 4 types of structures. It's when is the employee going to be taxed and how are they going to be taxed, and also what your reporting obligations are throughout the way. So the first step is the grant. You give your options to your employees. You say, well, we thought about it and we think that we want to change how your remuneration is going, and we want to introduce the concept of employee share option schemes. So we're going to give you those options. They will only vest if you stay with us for, say, 3 years or 5 years, and you meet your performance criteria. So under a default tax treatment, what happens is that the employee is taxed at the time of the issue of the shares. The rationale behind that is that it's as if you had given your employees a bonus, and that the employee had used that bonus to acquire some options or some shares into your company. So that's really what the government is trying to tax, to say, well, if you had gone through the process of a bonus scheme, then the employee would have been taxed up front. So how is that different if they had made the choice to get those options? So unfortunately for the employee, at that point, they have received absolutely no cash. So that means they need to find their way to finance that tax which is hitting them straight away. Generally, there's a lot of pushback from employees, as you can understand. They have the potential right to convert their options into shares if they manage to stay with the company for the 5 years and to meet all their performance criteria. And even then, maybe there's some additional payment they have to make to the employer to convert their options into shares. That's up to you as to how you structure things. And then once they've got some shares, then maybe you will pay them a dividend down the track. So they could be 5, 6 years away from any type of consideration. And upfront in year one, they have to pay the tax. So generally, that doesn't go very well in terms of discussion with the employees. And very often, we actually see employers that combine the employee share scheme with a bonus at that time so that the employee actually has some cash to finance that tax that they have to pay upfront. For you as an employer, what that means that you've granted the shares is that you need to give documentation to the employee and documentation to the ATO. The same way that when you pay a bonus to an employee, you need to include that in their pay-as-you-go payment summary. Same way you have some documentation you need to give your employees and the ATO. Now, let's say that the employee quits after 3 years. So obviously they have not met the vesting conditions. So they paid some tax on some options, which they never did anything with, and they never even got the full rights to those options to convert them into shares. So thankfully the laws changed a few years back, and the government said, well, all right, let's adjust for that. So if your rights to the options lapse before the vesting date, what happens is that the employee would get a tax refund. Still not wonderful because they've had to pay that tax up front and then they get the tax back, but at least it's not tax that they've wasted. Now, let's say that our employee is sticking around, has done their 5 years, and has met all their performance criteria and got full rights of their options. At that point, as an employer, you need to recognize that, and the state governments are going to impose payroll tax on you. Now, that's only obviously if you qualify, if you're above the thresholds for payroll tax. That's not going to trigger payroll tax by itself, but it's very often forgotten because when you're going through your process of processing your payroll tax and doing all of these compliance obligations, very often you don't think, oh, wait a second, I've got that employee who ticked the 5 years and the performance and now has the rights to maybe in a year or two convert their options into shares. So this is something that you need to keep track of and you need to keep a timeline of. And we'll see that in all 4 categories. It's always at the same time as at the time of vesting. Now, let's say that our employee whose options have vested and now has the right to convert those options into shares decides not to do so. Now, there could be a whole lot of reasons for that. Either it's just too complicated for them and they don't really want to do anything with it, or you've put some deadlines on how long they've got to convert their options into shares, which is usually a good idea. You don't want to be carrying that potential for them to acquire some shares for an indefinite period of time. Or it could be that you've attached to it a price, saying, well, if you want to convert your options into shares, you'll have to pay us $10, $20, $100, $1,000 per share. So your employee has decided not to exercise their options. What happens to them? Now, they've paid some tax originally. They're not going to pay some additional tax there, but it triggers what's called a capital gains tax event, which means that essentially they've lost something. They've lost those options that had a value because they've paid some tax on it. So then they would have a capital loss, which potentially could reduce some aspects of their taxes, but still not as good as getting the refund back if the options lapse before vesting. So the point of view from the government is that, well, as an employee, you had the right of these options. You had the right to convert them into shares. You made the decision not to exercise those rights. So then if you've lost that, then you've made a conscious decision, and it's not that nothing happened. You actually gained something from your employer and you decide to let it go. Now, let's say our employee exercise the shares, exercise their options, now have some shares. Down the track, they sell them. At that point, they would trigger some capital gains tax event, and they would have some capital gains or capital losses that would be triggered. If they've got some capital gains, then potentially they could get a 50% discount on the tax. So as I said before, that is the default tax treatment. If you don't structure your employee share scheme in any specific way, this is the way that your employees are going to get taxed. Now, the $1,000 reduction is essentially the exact same scheme, but has a few requirements to be triggered. The only difference that it has for the employee is that when they're taxed in year one on those options that they've received, if their personal taxable income is less than $180,000, they are able to get a $1,000 reduction in their assessable income. So the rest of it is exactly the same. You've got the same reporting obligations. They will also get a refund if the options expire before vesting date. They would also have some capital gains tax and some capital losses. So the requirement for the employee share scheme to qualify for this is that you need to be dealing with ordinary shares. You need to make sure that your employees, if they decide to, if the options vest and they decide to convert them into shares, they would have up to 5% of the voting rights in the company, no more, which very often limits that and takes out any kind of directors or employees or high-level management that might start growing into more than 5%. You also need to make sure that you're offering the employee share scheme to at least 75% of your Australian employees that have been with the company for 3 years. So a few restrictions there, but that the employee might appreciate that you're at least trying to do something to make sure that they're not getting hit with that big tax bill in the first year. The tax deferred is more what the employee is looking for. The concept of that is to say, well, the employee actually has not received anything when you give them those options. They've got the potential of maybe getting some benefits if they manage to meet the criteria of vesting. So as such, there's no tax imposed on them at the date of grant. Now, you will notice what that means for you as an employer is you actually have no reporting requirements at that time because essentially nothing has happened. That also means that if the options do not vest, nothing happens for the employee. They're not getting a refund on tax they haven't paid, fortunately. Now, let's say that the employee sticks around for 5 years and manages to meet all the vesting requirements. At that point, they are assessed on the discount that you gave them on the market value of the shares, same way that they were assessed in the previous examples. And at that time, as an employer, you've got those reporting obligations. It actually coincides with the requirements of paying payroll tax to the local governments. So that is generally a much more appreciated position for the employee. They know that at that point in time, they've got the option, if they want, to convert their options into shares. So they've got something tangible. It's no longer tied to their performance. It's no longer tied to their length of service with firm. It's no longer tied to anything really. It's up to them to actually take the shares. Now, one small issue though is that this is triggered at the time of vesting. It might take them a bit of time to convert these options into shares, and it might take the company even more time to be issuing a dividend. So still they have no cash in hand. Again, generally we work with employers to make sure that they plan that ahead and they communicate to their employees that they will ensure a dividend is paid very quickly after that date to ensure that if the employee is exercising those options, they'll be able to get some cash to support the payment of the tax. Now, the rest of it is the same as before. If once the options have vested, if they decide not to exercise them, then they will trigger a capital loss. And if they exercise them and eventually they sell them, then they could have a capital gain or a capital loss, depending on how the shares have been performing. The requirement for the tax deferral, or actually not that complicated these days, but still you need to make sure that you issue them with ordinary shares. So again, that puts a restriction on the employer. You can't say, I want to give them some A-class shares. They need to be treated the same way as the rest of the shareholders. So you can't keep the discretion to yourself as directors to say, well, I'm going to pay some dividends to the ordinary shares, but I'm not going to pay them to the employees. It's to make sure that it's all fair for everybody to have a regular portion of the dividends. Now, obviously, there's a lot of planning that is required to say, well, do I want to go into that type of scheme, because that puts some restrictions on you. But obviously, much more positively received by employees. And there's a restriction to make sure that employees do not have more than 10% of the shareholding. Now, the startup concessions. Startup concessions have made quite a bit of a wave in the world of employee share schemes. And we see lots of employers coming to talk to us to see how they could actually enter that type of arrangement. Now, the reason for that, I'm sure will appear very shortly. No tax on grant, no tax on expiry, no tax on vesting, and no tax on expiry. Eventually, the only time when there would be some tax payable by the employee is if the shares vest and they exercise the shares and eventually sell them years down the track. So it's a full deferral of the benefit that you gave to your employees until such a time as they sell the shares. That could be 20 years down the track. As an employee, that means that in the meantime they would have received dividends, they would have received the proceeds of the sale, they would have everything in hand to pay whatever tax is needed. But not only that, it's deferring it until the very end of the equation. So as you can imagine, that is something that, as an employer, if you can qualify for this, it could be a very great incentive and very much increasing the value of what you're offering to your employees. Now, in terms of documentation, you have to provide that documentation upfront to your employees. You don't want an employee knocking on your door 20 years down the track saying, well, can you please tell me how much those options that you gave me 20 years ago were worth at the time? So that's generally the reason why you need to be upfront with all your disclosures. Now, Unfortunately, the requirements to qualify for the startup concessions are quite arduous. Ordinary shares, of course, the same way that the other ones were working. You also have that limit of 10% of shareholding. But generally, the most onerous requirements are those that you need to have been incorporated for less than 10 years. And not just you as a business, but any entity which is connected to you, as in any of your subsidiaries or any of your parent entity. This is to prevent people from interposing entities to essentially refresh that timeline and move their employment around between entities. So yes, less than 10 years, obviously, which is why it's called startup. But also aggregate turnover of less than $50 million. But the last two criteria are the ones that generally genuine startups are struggling the most with. The first one is that the employee share scheme needs to be structured in such a way that employees are not allowed to voluntarily get rid of their shares within the first 3 years or their options. Now, that does not mean that if the employee leaves the company or if the company is taken over by another shareholder, they get nothing. There are specific exits for this, and this is actually allowed. It's to prevent employees from saying, well, I'm going to stick around for 2 years or 3 years, 2 years, 2 years and a half, and I'm just going to get rid of it. Now, if your employee share scheme has some vesting requirements which say that the employee needs to stick around for 3 years, then you're covered. But for a startup, when generally the people that you're trying to remunerate or employees which are giving way more of their time than their contract requires them to, and you're trying to generally get them invested in something that you're hoping is going to be worth a whole lot of money, it might be fairly arduous to keep them chained up for 3 years. And not only that, but the last point is the hard one to pass along, that the exercise price of the options needs to be at least equal to the market value. So that means that if you are a startup and your market value is nil because all you're making is losses and you haven't built enough goodwill and intellectual property that to say that, well, my market value is worth something, that's fine. You've got no problem. You can issue them and they can be an exercise price that is nil. But if you've started to do some fundraising, you need to make sure that you're structuring your argument properly, because why is a shareholder paying, so why are external parties paying to become shareholders in the company? And yet you're arguing that the market value of the company is nil. There's a bit of a disconnect there, and it's hard to build an argument in that way unless you can demonstrate that there's a premium being paid by the shareholders, that they're investing not in the market value which is today, but on their personal belief of what the company could be worth. So that's something that we work very closely with startups to try and establish. But that is generally what can stop a startup that does not have that much turnover, that hasn't been around for a long time, but it has built that value within, and do not feel comfortable pushing to their employees a requirement to pay market value for obtaining those shares. Now, in terms of reporting, there are some reporting requirements which are there. The same way that anything that you pay to your employees, unfortunately, comes with hundreds and hundreds of pages of reporting requirements to the ATO, to state governments, to the employee themselves. So you need to make sure that you've got all of that organized. And that means making sure that you've got tracking of where you are up to with every single step of your employee share schemes. And that's something that Eric touched on earlier on. You are not generally building your employee share scheme for a one-off event. your employee share scheme is a document that you're going to be setting up for the future. So it's a document that is going to be there to stay, so that you got some regular issues of employee share schemes, or the ability to issue some shares as the employee progresses, as new people come in, as you want to reward more people. And so it's making sure that when you've got 600-700 of different people that have started at different times and are at different points of different schemes that started at different years, that you're tracking where they're up to with vesting those shares, and specifically how are you tracking with your reporting requirements to the ATO, to the employee, and to the state governments for payroll tax. Now, there have been some recent developments in terms of legislation. So there's a current proposal from the government to put some relaxation around the Corporations Act and its requirements around prospectuses. We've got someone in the audience which is preparing a submission for the Institute of Chartered Accountants around this. So it's something we're looking at. And there's also a recent tax ruling which has been released by the ATO that deals with employee share trusts, and specifically in that complex environment, clarifying who's subject to tax. And depending on the circumstances, is it the employee, is it the employer, is it the trust? Now, very quickly, I want to finish by going through a very quick checklist of things that you should be keeping in mind at all times, not just in entering an employee share scheme, but also in administering it. So Eric has touched on a number of these. First question, what do you want to achieve? Make sure that you keep clear to your goal, because it's really easy to enter an employee share scheme and then to just keep it running without questioning it every single step of the way. Is that in line with what you're trying to achieve with our employees? Also, you need to be clear as to what you're willing to spend. Don't just look at the value of what you're providing, which is valuable, your shares, the rights into your company, but also look at the associated costs, administration costs, but also taxes and superannuation, anything else that could be added from your side. Not just in an employee share scheme, but in a bonus scheme or any kind of remuneration. You also have to rethink and challenge at every single step of the way whether an employee share scheme is the right fit for you. Have you considered whether a bonus scheme could achieve what you're trying to do, or a straight out issue of shares without conditions? Or is the solution to just give an additional benefit to an employee, like access to a company car? And at the end of the day, a major question is, what is the value to the employee? What is the employee seeing that they're receiving? And that doesn't just mean how much tax are they going to pay. You have to have a discussion with your employees. You know your employees better than anyone else. You have to know and to ask yourself, do they actually want shares in your company? Or is what matters to them the most their family? Would it make more sense for me to be providing them to pay for their childcare? Yes, that means some taxes that you would have to pay as an employer, but potentially you're saving on all the administration costs and you're transferring, for the same cost, you're providing them with something which has a whole lot more value to them. So feel free and challenge yourself as to what you're providing to your employees. And finally, what I recommend that you do throughout the process of considering employee share scheme or any type of remuneration strategy with your employees, keep the communication happening. Discuss things with them from the get-go. Do not find yourself in a situation when you have set up all your employee share scheme and you've got that beautiful scheme that is in place, Then you approach the employee and they say, no, sorry, not for me. I'm fine the way I am. Too complicated. Make sure that you start that conversation with them from day one, and make sure that you keep them updated on as to how things are progressing. You'll obviously get all the documentation. Make sure you spend the time or give them the opportunity to understand what they're obtaining. Again, it's all about making sure that they understand the value that they're receiving. Now, for all that, obviously make sure that as an employer, you're protected. It's not your responsibility to be advising as to what they're getting, but it's your responsibility to make sure that they feel that they are supported for that. And for them to be supported and for you to be supported, you need to make sure that you've got the right team assisting you with that. And that means having the right team internally to make sure that you've got someone who's going to be administering all of this, that's going to be keeping track as to when specific schemes are vesting, what reporting requirements are happening. And it's also making sure that you've got external parties which are helping you with that. That means talking to lawyers and accountants to make sure that you've got the right structure in place and you've got the right reporting in place so that something which is meant to create value for your company is actually building the right kind of value and the best kind of value. So thank you very much for this. I think we've got a bit of time for questions, so we're going to be moving to the chairs.